Fusion Mobile, quality e-learning experience on the go.
Welcome to Fusion Mobile e-learning platform. I'm Olokobe Kwalumi by name. The accounting tutor, and in this class we'll be treating accounting concepts and convention. So we'll be looking at the meaning of accounting concepts and conventions, okay, and different type of accounting concept like the entity going concern concept. We have the realization concept, accrual concept, margin concept, then periodicity. We'll also be looking at the historical accrual cost, the materiality, the consistencies, and the conservative conventions. So the meaning of accounting concept and conventions. Imagine you as a person, if you are not being guided by rules or laws or principles in any aspect of life, what will happen? Misbehavior comes in such a way that there won't be a particular pattern in which you follow. Views of life will be difficult and start behaving anyhow and something like that. So accounting as a discipline is having its own concept and convention. It's having its own guiding principle and laws in which an accountant or a person president has to follow in order to ensure consistency in the profession. So accounting concepts are just like a body of rules, laws, principles in which an accountant has to follow when preparing financial statements. So these are just like they are just serve as guiding principles in preparing financial statement, that is the income statement and the statement of financial position, which is the balance sheet in the organization. So we have the entity concepts, same to apply to convention also. So the first thing we have the entity concept, that is the business entity. What this concept, what this principle is telling us is that in the business or in the organization, we have to take the business as a separate entity. So we assume that the business is different for its owners. So the business will be a separate entity, a distinctive entity from its owner. So like the limited liability company, we know in the face of the law, the business is different from the owner. That is, the business having its own legal entity. But in the face of a sole proprietorship, the business is the same as the owner in the face of the law. But as an accountant, irrespective of the type of business, whether it's limited liability company or it's sole proprietorship, we always assume that the business is different from the owner or from the proprietor of the business. If it is a sole proprietorship, we assume that the owner is different from the business. What brings the owner and the business together is that the owner borrows the business some certain amount of money, which is the capital. That is the link between the business and the owner. The business starts as an entity on its own, whilst the owner starts as an entity on its own. So there should be some separation between the owner and the business. So we have the going concept, the going concern concept. We have the going concept. The going concern concept is saying that we assume that the business is the going concern, that there's nothing in the future to bring the business to an end. So we assume the business will continue to operate in the foreseeable future and nothing to bring the business to an end. So that is, we have to assume in that way. All these laws and concepts are based on fundamental assumptions which are generally accepted by the World Accountancy Body. So we have the realization concept. So what the concept is telling us that this concept is telling us that how can we realize revenues? So in what way can revenue be realized in the business? So revenue can be realized in the business when there is an obligation that follows the recognition of such a revenue. That is, how can we generate revenue? Revenue can be generated if the business has carried out its obligation in the business organization. That is, if the business sends a certain amount of goods to the customer, so the business has carried out its obligation. So the business can assume that the revenue has been generated in such aspect. Or again, we can assume that revenue has been generated if the customers themselves take over the responsibility and obligation to pay certain amount of revenue. So revenue is generated generally in accounting when there is when the business have carried out its obligation, that is, the business has sent some certain amount of goods to the customer. Not only goods, not only in instance of goods, or it might be in what, in form of services. If the business has carried out its obligation in providing services to the customer, what happened? The business can assume to have generated revenue in the process. So the next thing we have is the accrual concept. Accrual concept. This concept is actually different from, is generally different from the government aspect, which is the cash basis concept. But this accrual concept actually based on what the business organization is using. So what aspect of revenue or losses, or that is expenses, are we going to take in our income statement? That is this concept is telling us. So how can we assume that, okay, in the period in the income statement, what total income are we going to what take to our income statement, and what total amount of expenses are we going to take to our income statement? So that means revenue should be recognized in the period as N when the revenue is what is being generated. It's not assume whether we have received the revenue or not. Once the revenue has been realized in the period, we assume that such a revenue has been earned or income has been earned and taken to the what, to the profit and loss account. It doesn't matter whether the revenue or income has been received or not. Same thing applies to expenses. How are we going to assume that, okay, the expenses have been incurred? So we are going to recognize expenses in the profit and loss account or the income statement when such expenses have been incurred in the period. It does not matter whether such expenses have been paid or not. So an expenses is being recognized in the income statement when such expenses are incurred in the period. It doesn't matter whether the business organization has paid for such an expenses or not. An income is being recognized in the income statement when such income has been earned. It does not matter whether the income has been received or not. So that's what the accrual concept is telling us. Now we have the matching concept. The matching concept. Now the matching concept is telling us that, okay, in an accounting period, for us to determine our profit and loss, so we have to compare or match the total expenses in the period with the total revenue generated in the period. So we have to match the expenses we use in generating revenue to determine the profit in the period. So that means we have to compare the income with the expenses in order for us to determine our profitability in the business. So the next thing we have the periodicity. The periodicity. So since the purpose of a business is to determine its performance within a period, so determining this performance within a period can be determined within a period of time. It might be a month, a year, 2 years later, 3 years later, and something like that. So in what particular period are we going to determine the income or the profitability of the business? So that becomes a problem. The business organization can decide, okay, I can start preparing I can start determining my profit within a period of 2 years and something like that. So that becomes a problem. So we have to wait up to a period of 2 years, or business can decide, okay, I can determine my profitability in the period of a month and something like that. So this has to be generalized since determining the profit within a period of time. So we have to generalize it. So business organization think of it that, okay, the performance of the business organization should be determined within a period of a year. So that means an accounting period should be in a year. That can be from January to December. It can be from from February to the next year, January, and something like that. So that means to determine the performance of a business organization, the performance of such business organization is allocated or is put in a period of time. So you can't just wait, okay, the business is going to last for 10 years. Is it that 10 years we are going to determine the performance of the business? No. So we have to divide the performance we have to determine the performance of that business organization in different period of time. So which is called the periodicity. So, and generally these have been generalized, so you can determine the period you can determine the performance of a business organization within a year. That is being generalized. We should call the periodicity concept. So periodicity concept is generally in a year. Now we have the historical concept, historical cost concept. So that means generally in the book of account, the cost of an asset or the property that will be taken to the statement of financial position should be the original cost of the asset. That is, the historical cost of the asset should be recognized in the book of account. So any other cost apart from the historical cost of the asset should not be taken as the cost of the asset. That is, we have different valuation of an asset apart from the historical cost or the original cost. Like for instance, we have the realization value or evaluation value. We also have the market value of an asset. So such valuation should not be taken as the value of the asset in the book of the what? In the book of the organization or in the book of financial statement of the organization. But what should be taken as the value of the asset should be the historical cost or the original cost of the asset. And this cost includes the cost of purchase and the cost of carriage. So we have the materiality, the materiality concept. So in the depreciation value of asset we did last. So we talk about the depreciation of an asset. Okay, what this is telling us is how can we determine whether an asset is fixed or is a current asset. So the concept of materiality is telling us that, okay, how can we attach a value to some aspect of what? Of an asset, whether the asset is material or is immaterial. Generally, when talking about materiality, this is telling us whether to capitalize an asset or not to capitalize it, or whether to take it as capital expenses or capital expenditure, or we should take it as a revenue expenditure. So generally, if you look at it in business, a business that acquired a motor car in the period, what will happen? The cost of the motor car we generally will be taken as capital what? Will be capitalized rather, will be taken as a capital expenditure. That means it will not be what? It will not be expense in the period in which the asset was being acquired, but rather it is going to be what? It's going to be the cost of the asset will be spread over its useful life. That is the cost of acquisition of the asset. But let's take for instance, the asset bought, that is the motor car bought, will not be used for one accounting period, but you can use it for different accounting period. But if the motor car, the motor car that is being bought, we have a material value, that is a value of, let's say, 10,000 naira and something like that. But let's say a business that bought stamp or stapler in the period, and the stapler just cost 200 naira to the business organization. But the stapler will not generally also apply to the motor car. The motor car will not be used for more than one accounting period. Same thing happens to the stapler. The stapler will also be used for more than one accounting period. So are we going to capitalize this amount, which is 200 naira? No. We shouldn't capitalize this because of the immateriality of the what? Of the asset, of the stapler. But though the stapler meets the characteristics for depreciation, since it's going to be used for more than one accounting period, so we're charging depreciation to this value because of its immateriality. That becomes what? Wasting of time, and is not realizable, it's not reasonable enough for us to be charging depreciation to this amount. So what are we going to do? We are going to take expense this 200 naira in the period in which it was being acquired. So we are not going to capitalize the cost of the stapler within the period because of its immateriality. So what this concept is telling us that, okay, an asset of immateriality should not be capitalized in the period, but rather it should be taken as an expense in the period in which such an asset is being acquired. So that's what the materiality concept is telling us. So items of immateriality should not be capitalized in the period, but rather what they should be taken as what? They should be taken as an expenses in the period in which they are what? they are acquired because they are not having the word material value in the business. So it will be what? It will not be reasonable enough to be charging the depreciation on such an immateriality value. So the next thing we have the consistency concept or convention, rather, the consistency convention. Wow, this is an interesting convention in accounting. And what this convention is telling us is that, okay, we have different accounting methods in treating different accounting aspects in the period. So like in charging depreciation, we have different methods in charging depreciation, like what we treated in the aspect of depreciation. We have the straight line method, the reducing balance method, we have the some of the digit method, we have the evaluation method. So if an organization is to charge depreciation in the period and chooses to use the diminishing method or the reducing balance method, such an organization should continue using such a method, and that is should be consistent in the use of a particular method. Same thing applies to stock valuation. In valuing stock, we have different methods in valuing stock. Like we have we have the first in first out, we have the last in first out, that is the LIFO, we have the FIFO. We have different methods of stock valuation. We have the method that weighted average and so on and so forth like that. If the business organization choose using the LIFO method, that is last in first out, the organization should be consistent in the use of the method, and the organization should not fluctuate the use of the method. Maybe in one accounting period the business uses FIFO, and in the next accounting period the business uses LIFO. No. That is inconsistencies in the part of the accountant. So if an accountant chooses the method of depreciation as a straight line method, that organization should continue using that method in up to the useful life of the asset. That is, they should be consistent in the use of the method of depreciation that is to be used. So in any accounting period, any method choosing in valuing any value of an asset or in valuing depreciation, such a method, there should be a consistency in the use of the method. Now we have the conservatism convention. This is also an interesting one. Conservatism convention. So the conservatism convention means an accountant should be conservative in the treatment of profits. An accountant should be conservative in the treatment of what? Profit. That is the reason why we have that as what? Conservatism. That means an accountant should not be the one that anticipates for profit, but rather it should be the one to anticipate for loss and expense. So that means as an accountant, you should not aspire for profits. What happen? You should make provision for what? For losses and expenses. That is for liability. You shouldn't be the one that will be aspiring and overvalue your profits. No, but rather you have to undervalue the profit in the period. That means an accountant must be able to provide for all possible losses in the period, and also should not make provision for all possible profits in the period. No. You should make provision for losses and do not anticipate for profits in the period. That is what the conservatism is telling an accountant. So that is an accountant in the period of organization. If an accountant in an organization shouldn't be the one to aspire for profits and overvalue the asset of the business, but rather should be the one to anticipate for loss in the organization. Wow, this is an interesting method. So for someone to have a vast knowledge of accounting, this accounting concept is important. So someone has to know much of the concept and convention, because they serve as a knowledge, they serve as the guiding principle in the preparation of financial statements in the organization. So we talk about the accounting concept and conventions. That we look at the entity concept, the going concern concept, also look at the realization concept, we look at the accrual, we look at the margin concept. We also be talking about the periodicity, the historical cost, we talk about the materiality, the consistencies, and the conservatism. So if you have any problem with this topic, do not hesitate to repeat the video, and also some questions will be displayed on your screen. Do not hesitate also to attempt such a question. Thank you.